The following program is copyrighted by the National Center for Housing Management and is intended solely for individual, non-commercial, and informational purposes only. Any other use of this program, or any parts thereof, without the prior written consent of NCHM, is strictly prohibited.
Hello, I'm Nick Voto, Chief Innovation Officer here at the National Center for Housing Management. I'd like to welcome you to this breaking news presentation on the Housing Opportunity Through Modernization Act Final Rule. As our Vice President of HUD Programs, Wendy Fitzhugh, will illustrate to you in this webinar, HOTMA brings with it sweeping new changes that will impact nearly every HUD rental assistance program, as well as the Low-Income Housing Tax Credit Program. While HOTMA is intended to clarify and simplify the day-to-day work of PHAs and owners and agents, anytime things change, there are always opportunities as well as challenges. As we have for over 50 years, we want to assure you that we are here to help you master the changes that HOTMA will bring. In line with our mission and in recognition of the importance of this new rule, we are providing this breaking news webinar to every professional in our industry, regardless of status, at no cost. Our objective with this webinar is to reach as many housing professionals as possible to explain what to expect when HOTMA becomes fully operational and how NCHM is going to help you learn the details you need to know when you need to know them. Keep in mind, most HOTMA changes will not go into effect until January 1st, 2024, and HUD will be providing additional supplemental guidance in the coming months. So it's important to be ready, but also not implement the changes before they go into effect. Later this year, we will be offering comprehensive, live HOTMA training that will teach you exactly what you need to know and do to be HOTMA compliant. Our HOTMA training will enable you to master the HUD rules through hands-on case studies, quizzes, discussion, and more. As an added benefit, for those who hold a COS, COSP, COSV, or TCS, taking the HOTMA course will extend your active certification and meet the annual continuing education requirements, saving both time and money. In addition, we encourage you to check in at our dedicated HOTMA HQ at nchm.org/HOTMA and sign up for our HOTMA newsletter, where you will find the latest HUD updates and insights from our industry-leading experts. And now, for the first step in your HOTMA journey, I will hand it over to Wendy Fitzhugh. Enjoy the presentation.
Hello, my name is Wendy Fitzhugh, and I'm the Vice President of HUD Programs at the National Center for Housing Management. Welcome to our special presentation on the recent issuance of the Housing Opportunity Through Modernization Act Final Rule. In this discussion, we'll break down the major topics covered in the rule on February 14th, 2023. This will serve as a guide on what to expect when HOTMA takes full effect on January 1st, 2024. HUD plans to release further disseminated guidance as resources become available. This presentation will serve as a summary of those changes. As always, NCHM does not give legal advice, nor do we set policies for your owner or management company. Here's what you can expect to learn by the end of this discussion: the history and purposes of HOTMA, what changes to expect that will impact your income, asset, and deduction calculations, some revised definitions for key HUD terms, the applicability of new hardship exemptions, the changes coming to reporting provisions and certification obligations, new provisions for over-income households in public housing units, and the overall impacts to providers as well as residents and applicants. Let's start with the basics. HOTMA was signed into law several years ago, on July 29, 2016. Then, on October 24th of that year, HUD announced the immediate applicability of some streamlining changes that required further action from HUD. These appear in the Federal Register as docket number 5976N01. 3 years later, on September 17, 2019, a proposed rule was put forth in the Federal Register under docket number 6057P01. The final rule did not come out until more than 3 years later, on February 14, 2023, with docket number 6057F03. With the exception of a select few provisions, HOTMA will be implemented in full on January 1st, 2024. HOTMA arose to modernize very specific elements of the U.S. Housing Act of 1937. Here are some of its purposes. First, to streamline administrative processes related to certification, verification, and income calculation. It was designed to reduce burdens on public housing agencies, PHAs, owners and agents, OAs, and other responsible entities. It's intended to clarify long-standing confusion regarding certain inclusions and exclusions of income, and to align certain thresholds, deductions, and limitations more appropriately with contemporary economic conditions. Numerous affordable housing programs offered in the United States will be directly impacted by HOTMA, and some will at least be impacted peripherally. HOTMA will affect public housing programs, Section 8 project-based rental assistance or PBRA programs, rental assistance demonstration or RAD programs, Section 202 and 811 project rental assistance contracts or PRACs, Section 202 and 162 project assistance contracts or PACs, senior preservation rental assistance contracts or SPRACs, Section 811 Project Rental Assistance Programs, or PRAs, Home Investment Partnerships Programs, Housing Trust Fund, or HTF programs, Housing Opportunities for Persons with AIDS programs, or HOPWA, and Section 8 SRO Moderate Rehabilitation Programs, or MOD Rehab programs. Since low-income housing tax credit, or LIHTC programs, use the Section 8 definition of income, they will also be impacted by HOTMA. Sites utilizing tax credits should seek further guidance from their state agency. HOTMA is divided among 3 sections that modify certain elements of existing affordable housing rules. First, Section 102 addresses income reviews for public housing, housing choice voucher programs, and Section 8 project-based rental assistance programs. Section 103 is about continued occupancy standards for public housing. And Section 104 addresses maximum assets for eligibility and continued assistance for public housing, housing choice voucher programs, and Section 8 project-based rental assistance programs. As mentioned previously, regulations under HOTMA take effect on January 1st, 2024, with a few exceptions. Rules surrounding non-public housing over income, or NPHOI families, take effect on March 14th, 2023. PHAs must have policies surrounding the treatment of such families no later than 120 days after publication of the final rule. So that would be June 14th, 2023. Changes to the definition of included student financial assistance under Section 479B of the Higher Education Act take effect on July 1st, 2024. And the Earned Income Disallowance Program officially sunsets on January 1st, 2026. Many of the rule changes under HOTMA will also be subject to annual revisions due to inflation. For those restrictions and limitations, HUD will use the Consumer Price Index for urban wage earners and clerical workers, the CPIW, as an inflationary index for comparison. This happens to be the same index used to establish the Social Security Cost of Living Adjustment, COLA, among other things. Anything that is subject to the inflationary index will change effective January 1st of each year. Where it comes to forms and systems, HUD has confirmed as of now that it will be updating the 50059 and the 50059A, the 9887, the 9834 form used during management and occupancy reviews, and HUD's model leases. Tracks will also change to reflect HOTMA updates and integrate the new forms. Multifamily Housing has also announced plans to update the HUD Handbook 4350.3 soon. Now we'll start talking about specific program changes, beginning with income. In essence, HOTMA simplifies the definition of annual income so that it focuses on what sources are specifically excluded, rather than enumerating very specific instances of included income. The intention is to tighten up definitions of some words that had previously caused confusion. Here's a list of new income exclusions. Imputed income when net family assets are $50,000 or less. Distributions from any trust that pay the costs of health and medical expenses for a minor. All distributions of principal from irrevocable trusts, and that includes special needs trusts. Insurance payments from personal or property loss, such as through car insurance and health insurance. Amounts received in civil actions or settlements because of a claim of malpractice, negligence, or other breach of duty that's owed to a family member arising out of law that results in a family member becoming disabled. All income of foster children and foster adults. Housing gap payments. Non-monetary or in-kind donations from food banks and the like. Civil rights settlements or judgments, including back pay from them. Actual yearly income from IRAs and similar retirement savings accounts. Actual yearly income from family self-sufficiency accounts. Distributions from Coverdell Education Savings Accounts under Section 530 of the Internal Revenue Code of 1986, or any qualified tuition program under Section 529 of the Internal Revenue Code. Any payments from state Medicaid managed care systems that keep a family member who has any disability, no longer just developmental disabilities, living at home. Gifts for birthdays, holidays, or other special occasions, and veterans' aid and attendance. Also excluded going forward is any income earned by, governmental distributions to, and distributions from so-called baby bond accounts created or funded by federal, state, or local governments. Baby bond accounts are typically publicly funded trust accounts that are established for children born to impoverished or lower income families. They're created by individual states, and the intention is that the trust will grow in value over time. Once a child reaches a certain age, which is usually 18, they may access the money. Overall, the goal is to overcome or at least lessen the racial wealth gap for children who are born into less fortunate economic circumstances. Another new exclusion is for some payments from state agencies for in-home support of disabled individuals. Many states offer in-home supportive care options, whereby a person may be paid to care for a disabled individual in that person's own home. If a household member does this, and they're caring for someone within their own household, the income earned under the program will be excluded. However, if a household member is paid to care for someone who does not live in their household, their income is still included. HOTMA also adjusts the manner by which some student financial assistance will be excluded from annual income. The new rules will apply to all programs and not just Section 8. First, excess amounts of student financial assistance are excluded from income for both non-Section 8 tenants and for Section 8 tenants with dependent children. Second, the manner by which excess financial assistance is to be calculated will change. After July 1st, 2024, all financial assistance covered in 479B of the Higher Education Act will be excluded from income regardless of any excesses calculated. However, any financial assistance from other sources will still be subject to the excess rules. HOTMA also clarifies what constitutes as non-recurring income. Initially, HUD planned to further extrapolate the definition of the phrase, but after considering public commentary, HUD determined that instead of defining non-recurring in an expansive way, it made more sense to clarify exact sources of income that are included and excluded. HUD also makes it clear that day laborers, independent contractors, and seasonal workers all earn income that must be included. Now these terms all have HUD-specific definitions. The first term is day laborer. A day laborer is an individual hired and paid one day at a time without an agreement that the individual will be hired or work again in the future. These laborers typically do one-off or odd jobs, but often work consistently enough for this income to be their primary source of money. A day laborer is not someone who does one job one time and never repeats the task again. That's a sporadic job. The second term is independent contractor. An independent contractor is someone who does not qualify as an employee in accordance with the Internal Revenue Code federal income tax requirements, and whose earnings are consequently subject to the self-employment tax. Generally speaking, an individual is an independent contractor if the payer has the right to control or direct only the result of the final work and not what will be done and how it will be done. People who work for driving or food delivery apps are typically independent contractors, but so are folks like certain graphic designers and artists or consultants. They're not employees, but they make money from a company. The third term is seasonal worker. A seasonal worker is an individual who's hired into a short-term position and the employment begins about the same time each year, such as summer or winter. Typically, the individual is hired to address seasonal demands that arise for the particular employer or industry. People who take jobs in the retail or service industries during the winter holidays, or individuals who become employed by sports stadiums are considered seasonal workers. Though their employment may not last a full 12 months, the income is counted as a source of income for these folks. Now let's move on to changes with regard to assets. Many of these program changes align with some of the income definition revisions, and others are new rules entirely. HOTMA places restrictions on the amount of assets a household may have access to and still qualify for initial or ongoing assistance. It also incorporates CPIW inflationary data to make annual amendments to many thresholds. There are new asset exclusions to be aware of, and any items marked with an asterisk in this presentation are subject to inflationary adjustments. Here are the new asset exclusions under HOTMA. You may hear some echoes of the income exclusions mentioned earlier. The combined value of all non-necessary items of personal property, if the combined value does not exceed $50,000, all assets of foster children and foster adults, the value of any account under a retirement plan recognized as such by the Internal Revenue Service, including IRAs, employer retirement plans, and retirement plans for self-employed individuals, the value of any real property that the family does not have the effective legal authority to sell in the jurisdiction in which the property is located, any amounts recovered in any civil action or settlement based on a claim of malpractice, negligence, or other breach of duty owed to a family member arising out of law that resulted in a family member being a person with a disability, the value of any Coverdell Education Savings Account under Section 530 of the Internal Revenue Code of 1986, the value of any qualified tuition program under Section 529 of the Code, the value of any Achieving a Better Life or ABLE account authorized under Section 529A of the Code, and the value of any baby bond account created, authorized, or funded by federal, state, or local government, equity in a manufactured or mobile home where the family receives assistance, equity in property under the homeownership option for which a family receives assistance, family self-sufficiency or FSS accounts, and federal tax refunds or refundable tax credits. A very new feature of housing programs under HOTMA addresses caps on assets owned by a family. Households with net family assets that exceed $100,000 will be ineligible for assistance. Importantly, this does not apply to beneficiaries of the home program or people living in Section 202 or 811 housing. Another big change is that the imputed income calculation threshold will change from $5,000 to $50,000. If a household's net family assets are $50,000 or less, the family can self-certify all assets for verification purposes. HOTMA also introduces slightly new rules to the ways by which we calculate imputed asset income. If a household has assets that total more than $50,000, sites must calculate imputed income. A big change, however, is that if the actual income can be computed for some assets but not for all, providers must compute the actual income for those assets, calculate the imputed income for all remaining assets, and combine the amounts to account for the asset income of assets with a combined value over $50,000. While the passbook savings rate has been set at 0.06% since 2014, the number will be subject to annual revisions based upon the FDIC National Deposit Rate for Savings Accounts data. Yet another new restriction from HOTMA has to do with real property ownership. Households may not receive assistance if they own any real property suitable for occupancy, except if any of the following situations apply. First, the property does not meet the disability-related needs for all members of the family, including the need for additional bedrooms, proximity to accessible transportation, etc. Also, if the property is jointly owned with another non-household member that does not reside with the family, when that family member lives in the jointly owned property. If the property's geographical location makes it so that the distance or commuting time between the property and the family's place of work or school would create a financial hardship, and this is up to the OA's or PHA's discretion. It could be that the property is commercial and or cannot be legally lived in. An exception also applies if a family member cannot access it because they're the victim of domestic violence, dating violence, sexual assault, or stalking. That summarizes the changes coming to assets in assisted programs. Now let's look at what's in store for deductions. HOTMA both expands and simplifies the 5 deductions offered in subsidized programs. HUD did propose offering permissive deductions in Section 8 PBRA programs, but the option was eliminated in the final rulemaking. Still, there are changes to the existing deductions, including the fact that some are now subject to inflationary adjustments. First, let's discuss the dependent deduction. Right now, the deduction amounts to $480 per dependent, but after HOTMA, it will be subject to annual changes in accordance with the CPIW. Going forward, it will change in multiples of $25 and will be rounded down to the nearest multiple. For example, it could increase to $525 or $550. The definition of a dependent will remain the same. The definition of the child care deduction, however, has been simplified. It now means any reasonable childcare expenses necessary to enable a member of a family to be employed or to further his or her education. In addition to this, families may now appeal for a hardship exemption that will grant them the deduction even if they no longer qualify for it. We'll speak more about that later. The elderly disabled family deduction has been increased to $525, which is also subject to annual adjustments in accordance with the CPIW. The definition of the medical expense deduction has been revised substantially. In fact, the expenses associated with the deduction will now be referred to as health and medical care expenses. Health and medical expenses refer to any costs incurred in the diagnosis, cure, mitigation, treatment, or prevention of disease, or payments for treatments affecting any structure or function of the body. Health and medical expenses do include medical insurance premiums and long-term care premiums that are paid or anticipated during the period for which annual income is calculated. The final rule also suggests that when it comes to verbiage, HUD appears to now differentiate or separate an elderly family from a disabled family, though they both still fall under the previous category formerly known as an elderly family. So, health and medical care expenses include the unreimbursed health and medical care expenses of any elderly family or disabled family. The term disability expenses has been clarified to mean unreimbursed reasonable attendant care and auxiliary apparatus expenses for each member of the family who is a person with a disability to the extent necessary to enable any member of the family, including the member who is a person with a disability, to be employed. The deduction may not exceed the combined earned income received by family members who are 18 years of age or older and who are able to work because of such attendant care or auxiliary apparatus. Excitingly, the final rule allows sites to add together a household's eligible health and medical care expenses and disability expenses prior to subjecting them to the deductible threshold. Importantly, the threshold after which such expenses may be deducted has changed from 3% to 10% of annual income. As we will discuss momentarily, there are also hardship and phase-in protections designed to lessen the burden on currently assisted families. Here are the new hardship exemptions under HOTMA. The first applies to the childcare deduction. If a family no longer qualifies for the deduction because the family member is no longer employed or furthering their education, and they're experiencing a hardship that results in their inability to pay rent, they can request a 90-day extension of the applicability of the childcare deduction. Sites also have the discretion to extend the hardship exemption in 90-day increments. It's crucial to note that PHAs and OAs must have policies surrounding these exemptions, including what qualifies as a hardship and how extensions may be granted. There are two new hardship exemptions that apply to the health and medical care and disability deductions. First, if a family's health and medical care and disability expenses did not reach the 3% threshold prior to HOTMA, but they subsequently reached the threshold after HOTMA's 10% provision is implemented, they may qualify for a phased-in hardship exemption. This means the household will be subject to a 5% threshold the first year, a 7.5% threshold the second year, and then will be required to meet the 10% threshold the third year. The second exemption is an alternative to the first. If a family's expenses had reached the threshold and now have decreased income or increased expenses that result in the household now reaching the previous 3% threshold, they will be allowed a 5% threshold for 90 days. Families who qualified under Hardship 1 but who have exhausted their relief under it may also qualify under this exemption. Families can choose to use this hardship in lieu of the first hardship mentioned. If a family can demonstrate that their expenses increased or that the hardship is a result in a change in circumstances, they may also request this exemption. Owners and agents can extend this 90-day exemption at their discretion, or they may terminate the exemption if they determine the household no longer requires it. As you can see, these hardship exemptions were developed so as not to have a negative impact on existing tenants who have benefited from deductions prior to HOTMA's implementation. There are a few changes to reporting policies to anticipate post-HOTMA. The changes to reporting in subsidized programs are designed to reduce the overall burden on providers. First, foster children and foster adults are no longer counted as family members. You may have concluded that from our previous discussions on the exclusion of foster's income and asset sources. Another small change is that the EIV income report only needs to be run at the time of an annual recertification. There's no need to run it at the time of an IR. Going forward, the new 9887 only needs to be signed once per tenancy, not every year. HUD also introduced the concept of de minimis errors applicable during compliance reviews. A de minimis error is one that results in the determination of a family's adjusted income to be inexact by $30 or less per month. If such an error results in a family underpaying for rent, the family is not held liable for any difference. If the error results in a family overpaying for rent, the OA or PHA must repay. The best news for housing providers is that these errors will not result in a finding of noncompliance. Annual and interim recertifications will change a little bit for HOTMA too. By definition, sites are now required to use the prior year's income for annual recertifications. In practice, this won't be very different from how they'd been doing things, but it's an important definitional change. For move-ins and interim recertifications, sites will use the anticipated income of a household. Sites may also choose to use income calculation information from other means-tested programs, such as SNAP or TANF, to determine a family's income before applying deductions. This is considered a new safe harbor provision. Rules surrounding interim recertifications have changed significantly. Generally, a family may request an IR of family income because of any changes since the last examination. The site must conduct an IR within a reasonable time after the family request, or when the owner becomes aware of an increase in family adjusted income. Now, what qualifies as reasonable time may vary based on the amounts of time it takes to verify information, but this should not exceed 30 days. When it comes to income decreases, the site may decline to conduct an IR if it determines that the family's adjusted income will decrease by an amount that is less than 10% of the family's adjusted income. This is much different from the current regulation that uses a $200 threshold. Sites may establish a threshold that is lower than 10%, but not one that is higher. When it comes to income increases, the site is only required to conduct an IR when they become aware that the family's annual adjusted income has changed by an amount that is estimated to increase the income by 10% or more annually. Of crucial difference is that the owner may not consider any increase in earned income of the family when making such estimations, unless the family had previously received an IR for a reduction of income during the certification period, and the owner may choose not to conduct an IR in the last 3 months of the certification period. Unlike under previous regulations, sites are now authorized to implement retroactive rent decreases for previously unreported income reductions, but they may not go retroactive past the most recent IR or AR. Sites may consider doing this in the case of extenuating circumstances, such as a natural disaster that impacted the family's ability to report the change. Sites may not go retroactive prior to the implementation of the final rule, though. One major change impacts public housing residents who become over income. We'll discuss that now. HOTMA contains several provisions surrounding families whose incomes increase to a certain threshold after initial occupancy. If a family's income increases above 2.4 times the applicable very low income limit, they'll be considered to be an over-income family. If they continue to be over-income for a period of 24 months, the PHA must either terminate their tenancy or treat them as non-public housing over-income families. But this depends on the PHA's policies. These policies are required to be in place by March 14th, 2023. Here's how the over-income scenario plays out. Let's say that upon AR, a family is determined to be over-income. The PHA must notify the family of their income condition. The PHA will be required to complete another AR 1 year later. If they're still found to be over-income, the PHA must send them another notification no later than 30 days after they make that determination. This notice will inform them that if they continue to be over-income for another 12 consecutive months, the PHA will follow its over-income policies. Again, these policies may include termination of tenancy or the option of continued occupancy with a notification of the estimated alternative rent. Then, if the family continues to be over-income after the 24 consecutive months, they will receive a third notice that explains the PHA's next actions. The family will either pay the alternative rent beginning 6 months later, or they may have their tenancy terminated. If a family continues to reside in a unit after 24 months of continued over-income status, they're considered non-public housing over-income or NPHOI families. That means they can't participate in public housing resident councils. They can't participate in any programs designed for public housing or low-income families. They cannot receive federal assistance, including a utility allowance from the PHA. And they're also not required to comply with the community service and self-sufficiency requirements. NPHOI families are also obligated to sign a new NPHOI-specific lease. This lease will be month to month and must be signed no later than 60 days after the notice of the NPHOI status or at the next lease renewal, whichever is sooner. The lease will confirm the NPHOI alternative rent, which the family must pay 6 months after their 24th month of being over income. The alternative non-public housing rent, or alternative rent, is a monthly amount equal to the greater of the applicable fair market rent for the unit or the amount of monthly subsidy provided for the unit. There are a few more important points to note about NPHOI families. PHAs are permitted to create a preference for housing NPHOI families once they become income eligible again. Also, if the family falls below the over-income limit at any time during the initial 24-month cycle, the cycle starts over. Remember, over-income families must have their incomes examined annually, not just triennially. But even if they request an IR during the last 6 months, prior to their termination, but after their 24-month period of being over income, and they are found to be no longer over income, they are still ineligible to remain. NPHOI families do not undergo ARs. The last significant HOTMA provision is the end of the Earned Income Disallowance. Home and PHA program participants have taken advantage of the Earned Income Disallowance for many years. The disallowance made it so that if a disabled family member experienced an increase in earned income, the amount by which the income was to increase was phased in over the course of 2 years. It was an excellent way to incentivize disabled individuals to obtain employment. Unfortunately, the program was cumbersome in practice, and the Earned Income Disallowance will sunset on January 1st, 2026. Remember, households will still be eligible to claim the EID leading up to the implementation of HOTMA on January 1st, 2024. And existing households who have taken the EID will not be impacted. Let's summarize now what will happen in a post-HOTMA affordable housing world. HOTMA is intended to clarify and simplify the day-to-day work of PHAs and OAs. There will be fewer certifications to conduct, and we'll have clearer definitions for key terms. Calculations will become simplified, and there will be much more alignment among different housing programs. Residents should benefit as well. There will be more opportunities to increase wealth through assets, as well as more incentives to obtain improved employment, and there will be protections in place for times of hardship. Overall, HOTMA modernizes affordable housing programs, streamlines the provisions of services and subsidies, and incentivizes personal wealth growth. Later this year, NCHM will offer intensive, standalone HOTMA compliance training available to all housing professionals impacted by the new rule. The training will include in-class, hands-on case studies, quizzes, and more. Additionally, before the new year, all NCHM programs will be updated to reflect the latest changes brought on by this new rule. Pay careful attention to your inbox or subscribe to our HOTMA HQ newsletter for the latest developments and training news. Thank you for joining us today. We look forward to helping you navigate and master these sweeping new changes.